Alright, next up we have our great panel here. The dual track of RWA tokens, tokenization for institution and Web3 communities. So let's welcome.
Hello everyone, this is Sudeep from Mikeal, your host for the day, and I'll be moderating the session. We have a good panel here, bunch of mix-up of different fields. So we have Marco with us. Hi Marco.
Hi.
Just a quick introduction for the audience.
Yes, I'm Marco Lim from Web3 partner at SolarWind. So SolarWind is a Hong Kong licensed broker with the distribution capability for RWA. So we already have done some partnerships with like China AMC Tokenizer Fund. There's a few money market fund that we have been distributing as well, some private credit that's tokenized. So I'll come from more institutional regulatory background, so I think and on today is a quite good mix that I come from more, the other side of things which are more TradFi background. I also sit on the Hong Kong government Web3 task force as well, so I've been consulting the governments on opening up the RWA area, and then if you look across in Hong Kong now, there's quite a lot of projects that is tokenized, particularly on money market fund from traditional finance players.
That's great. Mikeal, just a quick introduction from your side.
Yeah, so my name is Mikeal. I work for ONX. We're a company that helps tokenizing institutional grade assets for RWA. So we also have a spots and future trading, and then our Web3 users can come and stake in our liquidity pools. But what we do most is with our US MSB license, we help institutional grade assets get tokenized on the blockchains.
Jeffrey?
Yeah, sure. Hey everyone, my name is Jeff. I'm the founder of R2 Portal. So I've been into the crypto for 7 years. I've been serial founders of different layer 1, layer 2, CK, you name it, I've been working on it. This project, R2, we actually make it easy for our end users to access the institutional grade yield. So you guys are like tokenizing those products. We're actually the distributors of you guys. We are working with 12 funds, including Securitized, Mercado, Bitcoin, Saxena, those kind of world-renowned asset managers, and we aggregated their products into different DeFi vaults. So anyone with USDCs, you can invest with no barriers. Yeah.
Papi.
Everybody, Papi, not my legal name, but what everyone's called me for years now. Work at Magic Eden as head of community. We started as your favorite Solana NFT marketplace, and then expanded multi-chain to other chains like Bitcoin and the EVM ecosystem. And now we say we are the best place to trade all assets on all chains, and account now for like 98% of all fees generated in true on-chain Bitcoin dApps, which is cool.
So we have, a mixed panel here. If we talk about, it's like one distributor, one person representing the institutional side for RWAs was, a big community, and another who's doing it for the same thing in retail. So just starting up the questions, if we talk about RWAs, there are two perspectives to it. One is the institutionalized side of things, where like more institutions are coming up with certain things. They want their share of fractionalization of assets. Fractionalization it was called earlier, now it is called tokenization. So they want the tokenization of real world assets, put it into perspective for the retail investors to have their share of market. While on the other side, there's a crux. There is a build-up of the core Web3 community, which just want everything to be free, decentralized, not institutionalized. So I would first go to the people who have been doing it earlier in the Web3 ecosystem, like Mikeal. The question would be to you. So how do you find the institutional side coming into picture? Having worked with the RWS in the past. So institutions coming into this ecosystem, is it a good thing for the market? For the market per se, retail investors. Second is it a good or a bad thing for the very essence of decentralization? Because power is being concentrated in a few hands again if institutions are coming. Sorry, Marco, but that's how people put it up.
Yeah, I don't think it's a bad thing at all. When it comes to decentralization, the goal of decentralization is trustless cooperation, right? That's why the blockchain exists. And so you never want to decentralize just as a buzzword, just because it's not an end goal, but more like a means. And so if you take a community like Ethereum, for example, you want to have a recognized leader. So there, even though you're a decentralized project, you still want to have some centralized aspects to it. Recognize leaders, really good, really useful. If you run a company, you also want somebody at the top that takes the decisions. So I think the important part is if you have, well, first it starts with the code and the smart contracts. That's really where that all happens. So when we talk about trustless cooperation, think of it, you have different parties with different incentives and different goals. And some of these parties can be centralized, that's totally fine, and some parties might be decentralized. For example, if you take a real estate project, let's say you're trying to tokenize a real estate building, well, you're gonna have liquidity providers, which is a fully decentralized pool of people that are providing liquidity and they're all the same. You'll have the real estate company that's creating the project, which is centralized, and you could have the third player, which is the platform facilitating that connection, which could be decentralized or centralized or both. Like us, we're CDFI, so we touch on both bases. So what really matters is not whether these parties are centralized or decentralized. What matters is the chains in between them, meaning the smart contracts that are creating that trustless cooperation is very decentralized. So, I mean, it just comes down to fairness, really. You just want to make sure that all parties are achieving their goals and not one player can overtake the other players. That's really the main difference. Then, if there were no smart contracts, there would usually be a centralized player that's managing the whole operation and being a key participant in that operation at the same time, and then all the other participants kind of have to yield to that power. So, in short, I don't think it's a bad thing at all as long as the code is well written.
Well, Marco, having been into the institutional side of things, I mean, regulation is something that kills a lot of innovations, a lot of things. So, being from the institution, regulation is a prime concern to you. So, what regulations do you see coming into the way of actual RWA tokenization, and how are you dealing with it? Because you told just now that you're working with government as well, you'll be talking to authorities and things. So what are their concerns about the regulatory perspective when it comes to RWA tokenization? How are you going to solve this problem?
Yeah, I think one of the concerns on regulators, government is, the KYC ML. Eventually, I think the biggest tokenization successful case right now is stablecoin, right? But we still have these conversations on KYC ML. That's why Tether come up with USAT, right? There's tighter regulations on that. But I think the debate is always, the traditional guys always want to tap into DeFi liquidity. I mean, Mike was right about, I think on the DeFi side, we wanted to tap into that liquidity, but at the same time, we can't go directly into DeFi. I don't think that's what regulators wanted, at least at that moment, right? US regulators, they're more forefront, but from Asia regulator perspective, I don't see any Asia regulators come out and say, oh, I'm gonna be fully DeFi. But at the same time, we want to access that LTV. Right now, if you look across traditional finance, Benji, Franklin Templeton, Builder, BlackRock, they're all doing this money market fund. They already have, enough people buying their, tokenized money market fund originally. Why do they want to tokenize this and put that on chain, right? As they can access a bigger market. When things that they cannot do, they can now rely on some of the distributors to actually securitize, to actually help them tokenize, put that on DeFi, work with the different exchanges, different protocols, able to access that liquidity. So where these traditional guys were not able to access, now they have the access. So I think I totally agree with what previously Mike said. This we need to have the DeFi pool where they are helping on building that infrastructure either on Ethereum or Solana on different chain. Make sure that protocol works well, but at the same time on the issuer front, we want to make sure the KYC, AML custodians all comply with the traditional regulations and rules, so then we can move this forward. So I think it's now finally coming together. So I think this year is pretty hype with everybody, including Hong Kong, China as well. You see there's so many RWA projects coming in. Just because we want to tap into this big liquidity, particularly there's some projects that you can never get LTV or easy to get LTV. Now we have a marketplace that provides us LTV. Why not?
Papi, coming to you, representing the community.
Yeah, I think for me it's mostly about.
Let me just let me put things where I want you to point out specifically. Is community happy with institutionalization? Is community happy with not being anonymous? And of course, the perspective on RWAs.
Oh man, anonymity and institutions coming in, I would say it's like two parts. On the side of the institutions coming in, I think your average retail degen hears that and translates it to exit liquidity. So they're like, hell yeah, man, this is great. On the actual day-to-day impact for them, I think we have such a broad stroke of products and opportunities that are out there that it maybe doesn't actually necessarily impact their day-to-day. Like this specific offering is not for them. And in a parallel path, there are other things that are more in line with their interests that are being further developed and made more available. And especially, I think, just even what is in the scope of RWAs as a whole is changing a lot, right? Like, you brought up the Franklin Templeton offerings. For some people, this is a massive improvement over what they've experienced in TradFi, right? So this is going to bring them on the chain. The yields are available daily. There's no 5-day market. It's 7 days a week. So this is like a genuine UX improvement for someone who has maybe been stuck in TradFi and can sort of bring them on chain. For your average retail degen, they're like, I'm never touching that, right? They're like, do your thing, grandma. I'm so happy that you're like dipping your toes in this world, but it's not for me. And I think for them, they're looking at more of these like sort of trustless, decentralized opportunities like X stocks we've seen roll out as tokenized versions of Tesla and all of these sorts of things that don't require KYC and are more in line with their sort of risk profile. And that's great. I think both can and should exist sort of in an ecosystem homogeneously, right?
Jeff, coming to you. So you have been working on the distribution side of things.
Exactly.
Just on the RWA per se, if we talk about, it was just gold, and gold. Gold tokenization, real estate tokenization, nothing else than that before like 2 or 3 years from now. But now things have gotten a bit further than that. People are talking about lithium being tokenized, people are talking about cobalt being tokenized, people are even talking about uranium being tokenized, which you can never lay your hands on unless you are a government, right? So what is the shift, the change in the asset base that is being tokenized these days? I mean, for the communities, obviously institutions have been dealing with these kind of assets since ages. But you know, for the community, the projects were tokenizing on a very, very limited number of assets. Is there any increase in the base, and how is this faring with the community?
Yeah, no doubt. I think there's going to be more assets being tokenized on chain, right? So far we have seen TBLs has become a trend. Everyone's using TBL as the underlying assets, but we also see like creativeness, like private credits or real estate or stocks, even, right? I mean, no doubt there's going to be more on chains because TradeFi opens the door, and the DeFi actually provides some tools. The infrastructure is ready. The people is ready. I mean, but like the one thing that we observe now is like even though those assets are on chain, but they still need KYCs and asset verifications, right? This takes a lot of time. This makes no differences with the Web2 world. But like for us, we are trying to solve this problem because we're working with those asset managers. We provide very easy access for our DeFi users to tap into these ones, and also because we're dealing with both sides. On one side is the DeFi communities, the other side is the asset managers. We understand both sides. They actually, for example, like the asset manager, they want to tap into the DeFi liquidity, but like the DeFi communities want, simple access to these institutional grade yields, right? So we become the bridge for them. We bring both the convenience for both sides. The other things like I know like asset manager, they want to leverage with the DeFi tools. For example, Morpho, you can do the looping strategies. The underlying assets are actually very high quality collaterals. So you can do the looping strategy as long as the borrowing and lending rate is a little bit higher than right? So I mean, there's plenty of opportunities that we can tap into or look forward to. Yeah.
So enough of the knowledge stuff, the boring stuff. Let us get to some spices. So Mikeal and Marco, the direct question, anybody who can answer and you may even debate on it, is that is lack of anonymity going to kill the very essence of Web3 ecosystem? I mean, especially for RWs, like institutions coming to RWA will definitely be vouching for KYC and AML, like you already said. And I mean, most of the community is not so interested in going for being non-anonymous. They don't want their identities to be disclosed. I mean, starting from the genesis of the blockchain ecosystem, Satoshi. So, is it going to kill the essence of Web3, or will there be a clear divide in the traditional investors who are willing to invest through institutions and the modern investors in the crypto ecosystem? So, I mean, both of you, anybody can answer, and you both can answer.
From my perspective, I think it's good that we kind of divide the pool into two. But right now, institutional is getting in a honeymoon period where, oh, actually, I have this 7 days settlements or 24 hours market that we, in traditional finance we never see. Right now, Nasdaq not running 24 hours, 7 days a week, right? But we've seen this market already running.
More particularly, you can actually you can at least sleep when the market is closed.
Yes, we don't rely on banks. If banks don't open, we can't settle the trades. We now bypass the banks, right? So I think that's actually very powerful. And if you're looking into further, I think yes, KML, KYC is a big discussion towards between regulators already globally, right, on a scale. But at the same time, they want to test that out whether that increase the efficiencies and liquidity in the market. At the same time, they want to get that, as I said previously, they want to get access to that liquidity. They know it's a mass market. They can't get to the degen. But right now, is there a place out where they can get to the degen, but meet somewhere in the pool where the degen can be anomalous at the same time? I think that eventually is the key discussions where I think people are still divide that into two, which is a good thing, right? If you look at it, now TradFi people can actually arbitrage between anomalous pool and anonymous pool as well. So I think that creates more trading opportunities in the market.
Okay.
Yeah, I think that's a great point. So obviously you have permission token and non-permission token. And so I'm gonna bring it from more of a product perspective. I think the RWA challenge to be solved is really from a product UX perspective to really take off. I think there's another challenge we want to solve with digital notaries, but I think we're gonna go there a bit more later. But up to your point, I agree into meeting into the middle. From a product perspective, the problem with KYC is just it's so much friction, right? Somebody just wants to check your Mini app in Base or in Trust Wallet or whatever, right? They just kind of encounter you. If they have to do a KYC to even know what the product is, you're not going to be able to get that momentum. So I think if you're able to meet somewhere in the middle where it could either be some projects, just imagine you have some sort of a Kickstarter type interface, right? Where I can browse different RWA projects and I can choose what to invest in, which I think is what the future is going to look like. Because if you think of it that crypto was just this yield, single liquidity pool, and people just give their money and they get a yield back, it would not be as big as it is now. There's kind of like that gamification fun of choosing where you want to vote with your money, what you want to support, and then all these events with these different communities. So I think for RWA to really pop off in terms of the Web3 user, the degen, that maybe started like 7 years ago, and he made a lot of money in mint coins, but now he's like 30 now, so he wants to kind of diversify his portfolio. I think if you just give him a liquidity pool that says, give me your money and I'll give you a 6% yield based on that investment, I think that's never gonna take off. I think the RWA super app that's gonna, and I think it is up for grab to a sort of RWA super app to really kind of cement itself and kickstart that market. I think it's going to be a lot more like a CoinMarketCap, like a Kickstarter, but for it to really take off, I think the KYC is going to be a big barrier if they need to get it straight from the beginning. So what I can think of with your question is just having KYC on some type of project and non-KYC on others. For example, real estate projects could require KYC, whereas something else, wouldn't require it. So I think meeting in the middle is how I see it.
So the next, the hot thing is for Jeff and Papi. One from the community side, one from the distribution side of assets. What would you vote for? A product or the real world asset? Which is more important in this scenario? I mean, since ages, Web3 has just been about the products that you are building. They are more complicated, more non-understandable to the traditional people or the real world people, we can say, real world people and crypto people. While this is the product, where you like jumble up things within itself, complex tokenomics, white papers and everything, of having a real world asset in a fractional format. So asking you both should answer, what would you vote for? A product, complicated, more sticking rewards, more risk, more circulation, or a real world asset, limited supply, fractionalized, brought it up for you to buy and for your community to buy and then take it forward from there.
Can I go for both? Because I think this is a perfect combination. So you could do like underlying assets or real world yield is actually the core, placed as the core of your products. But on top of that, what King says is like, Mickey says is like you can build some mechanism on top of that, right? Previously in the DeFi summer, actually most of the DeFi products that you're farming is actually based on narratives. It's dumping tokens or something like that. But now we finally have something in real world that brings the guarantee or the base yield for your products, and based on that, we can can make some combination of the old DeFi plays, right? Olympus DAO or something like that. It makes more interesting or intriguing, like for users, and provide you like a higher yield if you're really plays well in this. I mean, it's like crypto, right? We need to have some like gameplay for your token side. Yeah.
Yeah, I guess I would say it really depends on who your sort of end user is, Like, to Mikey's point, if you've got a new product and it's giving you 6% yield, the degen's probably not going to get super excited about that. If your end user is like a more normal person and you can just 10x access, ease of use, I think that's like a great opportunity for a broader sort of approach, right? In your go-to-market to say, hey, I do want to get like true retail, not Web3 retail involved here. And this is a huge improvement in their experience. An example maybe of something similar to that in Web3, I know we haven't really talked about this, it's outside the institutional scope for sure. The tokenization of like TCGs, like Pokemon cards and things, right? I'm a Pokemon card collector. I went and got a pack the other day here, pulled one of the chase cards in the new Mega Evolution set. It's like a $300 card, and now I'm like, how the fuck do I get it home, I gotta go get a case, I gotta put it in my backpack. Now, if I could have that same experience on a collector crypt or a similar protocol, my experience is 10x. I don't need to transport it, I can still flex it digitally to all my friends who are pretty geographically dispersed anyway. And I haven't like fundamentally added another layer of speculation, but I've made the ease of access and interaction much simpler. On the other hand, for a lot of people, they don't care about that at all on the like community degen side. They're like, I have specifically avoided gold because to me that is very boring. And maybe I don't even have the size that if gold were to continue at the trend it is now, that would be a tangible difference in my life 10, 20 years down the line. So I'm looking for an expanded opportunity and something that's a little more gamified, does have a little bit higher risk, and that's okay for me. And I think that's most like existing retail degens are much more in that sort of pocket of users. So for me personally, I would probably be closer to the 30-year-old guy who has done okay and is like, I could do with 8%, that's all right. But I don't think that the majority of my community would necessarily be in that pocket. Even the ones that are well off, a lot of the guys in there are crushing it, and they're like, I don't care, man, I'm trying to keep compounding forever.
Just one thing, that's a question any one of you can answer. RWA and stablecoins have been the buzzword for quite like 3-4 months. Every conference, every convention we're having, we're just talking about RWAs and stablecoins. Everybody's going gaga over that. They're building their products basis these things. But so has been NFT before some time, before a few years. So has RWA having a certain sense of real world touch and as underlying asset to put some value to the product. But will it prove just to be a buzzword and the next wave of projects will keep coming forward for some new concept? Or will it sustain for the longer run? Because when you're putting your money into the assets, the investors are putting money into these assets, then you need to see what is the horizon. Especially people who come from the traditional side, because adoption is the key. And if you want to onboard more people, the new generation is already onboarded to crypto. They are sold to the concept. But now if you want to bring more depth into the market, you need to have people who have access to money, who have old money, who have kept money in their pockets in stock markets and other institutions. If they come to the market will be more buoyant and the market will have more depth to survive, to sustain shock. So if we talk about this, will it turn out to be just a buzzword or will it sustain in the longer run?
Yeah, I think buzzwords are good in the sense that they help kind of take a very complicated concept and really narrow it down. I think it was you that said you take a bridge kind of like on both ways. I think RWA is kind of like how I think about it too, because it has the word asset into it. You think it's kind of like an and thing, but I think of it more as kind of like a bridge. So you could think of MicroStrategy kind of taking that bridge on one end, and then some other people taking it on the other end. I don't think NFTs are dead. I mean, maybe like, the price are down, but I mean, the concept of a non-fungible token is something that's actually really relevant still. It's a bit of a different situation too. For example, when I was in Canada, I used to work in a real estate company called Capri. They have the most stores in Canada for leasing. And a year ago, the boss of my boss, so pretty high in the enterprise, he calls me and he says, I'm starting my own real estate business and I want to tokenize my first construction project. And I knew this guy knew nothing about crypto and did not own Bitcoin, far up. So I think RWA is actually kind of becoming a bit of an on-ramp for these type of more experienced people with very good expertise in certain fields like real estate, like more traditional fields, they have the expertise to create really valuable projects with really valuable yields, but they don't have the liquidity to do it. Maybe they can raise, $1 million or 2 or 3 from the bank, but they're kind of missing the other 4 million. So they're kind of like in this situation and they look at that DeFi liquidity and they're like, oh, this is where I'm gonna get it. And I think that's a really good thing because if I want to invest in real estate, let's say I have 50K to put in, well, okay, I can buy a house, but I'll get a much better yield if I get an equal cut of a 200-door apartment complex in like El Salvador or somewhere where the real estate market is even better. Because if I buy a house here, I need to manage it across the world. So I think it's like really win-win for both the liquidity providers and the experts. So in that sense, I think RWA is not going to die. I think it's going to evolve more in the same direction that it is now, different than the NFTs.
Yeah, so echoing with that, very interesting. I had a conversation years before with a GPU company in the US. Actually, they're earning like 30% of APYs yearly, but like they want to scale, right? It's super hard to raise the money nowadays, right? So what they want to do is like, okay, I can do the profit sharing. I can give our end user like 15% of the APYs per year, but I want to raise the money, right? Leverage on the RWA on the stuff. They can actually, you can think of this of very small fundraising stuff, right? People give you the money so you can scaling your company. This is just one of the things that some like real estate companies or some like real world companies, they can use the technologies to have benefit their companies. But there's a plenty of tools for different people to leverage on, to use the technology of the Web3 world to do things, right? And also like RWA for me is like, it takes a long time. The compliance side, the regulation stuff, it usually takes a lot of time for TradeFi stuff. So as you can see, RWA becomes a buzzword in the previous two years or something. It's actually growing a lot. My expectation is the RWA is gonna last for like 10 years or so, like cause with more assets on chain. Because the regulators, policymakers, they were gradually turn favor into this kind of RWA world. Yeah.
Yeah, I guess I would add to sort of on the retail side, like the mass retail side. This is, I think, a really big upside opportunity. If you're an organization who in general is like trying to play to crypto Twitter, you're trying to play to like maybe 200,000 people, right? Who are like very active and maybe more considered your peers. But in the really broad retail setting, I think these things become more and more attractive. Like right now in the US, as an example, homes are the least affordable they've ever been. If you look at the distribution of spending power in the economy, Moody's recently said it's like the top 10% account for 50% of total spending, which is up from the mid 30% in the 90s. So we're having like a general economic sort of contraction and consolidation near the top. And so for me, these are really interesting opportunities that, for millennia, really your average person has not had access to, especially at the sort of scale that matches where they are in their life. So I think for me, this is a really great chance for companies to build something that's real, tangible, lasting, and that has a much broader appeal that can sort of get those people more interested in maybe the things we participate more in on a day-to-day basis.
Yeah, so I don't know if you guys know way back in 2019 when security size started long ago, It not used to call RWA, it's called STO, security token offering, right? But the security word kind of push everybody who are in degens away, right? Every time you mention security, the security commissions come in, Hong Kong regulators come in, US regulators come in. Once now we change the word RWA, right? That doesn't happen anymore. So I think, and securitized wait until BlackRock come in and acquire a big chunk of them to get this started. So I think that I see tokenization as a revolution of changing the entire infrastructures of banking, right? We used to, don't have these LTV, don't have DeFi. With this tokenizations technologies, we are able to do a lot of things. Whether a standard asset or a non-standard asset, like uranium that you mentioned about, or Moutai or whiskey or anything that you can think about, you can get it tokenized. Of course, that gives everybody a pitch. So I think the tokenization is not a new concept. Since it's crypto, since the born of Ethereum, people have been using that and trying to tokenize stuff. But it's just that, we tried in 2019, nobody was looking at it. And right now in 2025, we tried again. Seems like more people are able to adapt. So I think it's an ongoing process, but I truly believe that eventually most of the stuff will go on chain, but it's just the process of what should go on chain first, and later on what should go on chain later. So I think that eventually is the process I will evolve into.
So just one thing to add, just a little perspective, is that when we are talking about the real world assets coming into picture, till now it's like all the technical stuff people are talking about, and if you talk about DeFi, DGen, things like that, and the traditional investors like, oh, I don't know any of that stuff, I won't put money in that. But when you bring real world assets into picture, so will bringing real world assets, fractionalization, fractionalization has already been there, ETFs have already been there for other assets. But tokenization is a new concept. You can buy it anonymously through a platform across the borders. That makes it easy. So if I want to buy a tokenized asset, let us say a particular commodity out there in US or maybe Southeast Asia, I'm sitting in India, I can buy that, which is not possible with the regulatory perspective. So if we talk about this, whenever there has been a fractionalization, whenever there have been derivatives made out of the real world assets, then there has always been a price upsurge, and there has always been less stability and more volatility in the prices. So is this kind of thing, bringing tokenization and like playing with prices, meddling with things, bringing more of retail investors on board, will it be good for the market, for the real world asset market? And one thing, second thing to add to this is, will this be more conducive to the other side of the world to start investing in the tokenized world?
I think to your second question, it's a huge opportunity. Live in Mexico, spend a lot of time in various areas of Latin America. If you look at just like very recent history, right, what's happened in a country like Argentina, just having access to stablecoins is like, oh, what a godsend, right? Now if you can go above and beyond that and you can create an even greater differential of an additional 10, 12, 15%, whatever it might be, maybe for me that's on a normal day fairly boring. For somebody in a different financial situation, it's literally life-changing, right? So I think it's overall a very good thing to have this sort of like open monetary access globally to things that are also more bite-sized and attainable based on the capital that these sorts of people have. And as far as like, overall is it good? I definitely think so. I mean, if you're able to open up access and there's not some horrible access event that takes place where all of a sudden that's withdrawn and the number of like participants in the pool shrinks overnight, I think it sort of just creates almost, to some degree, a new floor of what's happening there, right? It's like going from 10 people at the party to 20 people, and you're hoping you can get to 30, but you're never going to go back below 20, right? So you've just set a new energy at the space is all.
Yeah, for the first part of your question, I don't know if anybody of you is familiar with the term DeFi matrix. So pretty much the idea of the DeFi matrix is when every asset becomes liquid on chain. And so if you think of an order book, every asset starts competing with every asset. So if you could imagine, let's say milk is tokenized, imagine just everything in the world is literally tokenized, then every asset starts competing against every asset. And then your question is, does that create volatility in the price of the assets? Well, obviously it does, right? Because what's going to happen is now, if every asset becomes liquid, then you're going to find out that some assets had less or more value than it actually had. There was a lot of assets that were just kind of like not connected to the rest of the market, so they looked like they were very valuable, but then when everything becomes liquid, then the price starts to change very rapidly. And then the analogy for this is when Google came in and they started doing the SEO for the articles, then you saw a lot of journals just like die, right? Because they were just copying other journals and they could kind of get away with it. But once everything became online, then like the whole dynamic completely changed, right? So I would equate that to the same type of volatility. And I think the more we can get close to that DeFi matrix, the more powerful the economy becomes. So I think that volatility is actually a very great thing. It removes friction, and ultimately that's what creates wealth. So to your question, more volatility, and it's good, yes.
I think even in the traditional world, there's volatility, right? If you look across US equity market, there's stock that is less volatile, there's stock that's really volatile, but there's stock in the middle, right? If Tesla is going to tell you that it's going to move up 100% down 200% there will be still people trading it, there will be less people trading it. But if you tell people that, oh, Tesla is moving 5 to 10% a day, healthy volatility, which we call is more healthy volatility. You need some kind of volatility to attract people to invest. But you cannot have a stock that has zero volatility, the price is going to stick in 100 for 3 years' time. I don't think anybody will trade Tesla in the end, right?
I mean, a flat line means
flat line. It means that, right?
Even volatility, you cannot.
Even the asset is going to pay you 5% dividend a year, but it doesn't move, right? So it does not move, then it does not create any volatility, which is not good. So we've seen that in traditional finance. Why money market fund? Money market fund have been dead for a while. Who will still buy money market fund in the world? Right? Nobody. But right now you put it on chain, oh, seems like something new, but actually it's not something new. So people start looking into it again and say, hey, let's buy some money market fund. But actually people can walk in HSBC, any bank available, and you can purchase money market fund for the last 20 years. Nobody do that. But right now you wrap it into a different marketing. People seems like, hey, actually I can do more with my money market fund. Before, my money market fund sit with the bank. Right now it can sit with Binance, sit with OKX, sit with other exchanges, sit with some DeFi pool. It allow me to get some LTV and trade other stuff. Why not? So I think, volatility is good, but too much might not be good. But it might be good for some people who love to gamble more. But for most of the people, normal people, they want some volatility, but at the same time, they don't want max volatility in some way. So, we need a balance between, high volatility to no volatility. So somewhere in the middle is good.
Yeah, so for me, it's like, I think like people want more choices on chain, right? You put more assets on chain, you provide them more diversification and the more volatility. I mean, there's always like opportunities inside because it's always, everyone has their risk appetite. Somebody will choose T-bills and probably choose private credits, and somebody choose perps, right? As long as there are opportunities, I think they will make their own choices. It's not a bad thing at all.
So just a quick question about an important aspect that we have not been discussing till now, the security, right? For platforms, it is the security in the technical side. But when it comes to RWA, we are talking about a real world asset, we are talking about the gold. If somebody is tokenizing a gold, it's not buying it on paper, then he has to have physical gold stored somewhere. So how much does the security of the real world asset itself plays a role in its ecosystem? Just I would like to have a half-minute bite from each of you on that.
It's greatly important because think about your goal is disappeared, right? Doesn't matter the certificate you trade, survived it, if your real physical goal is gone. If the asset itself is a digital asset, then the aspect is very different. If the asset is a real world asset, that asset needs to be custodized somewhere, right? It can be art, it can be whiskey, it can be anything. That custodian is actually the most important. That's why we're not changing. The DeFi or tokenization does not change that custodian part of it. That's what the traditional finance guy have been doing for the longest time. We are adding a wrapper into it, making that certificate easier to remove a wrap. So I think the custodian itself have to be safer in any case, because if people are trading such certificate, in the end the custodian itself is not safe, it's gone, right? Then I don't think anybody will trust that out of any.
Yeah, so you guys know Certic, right? The auditing company. So when I'm looking at a project and I see Certic, I'm like, okay, this somewhat legit, right? I keep looking, keep investigating. I think the same type of thing is going to come out for RWA. I think there's going to be a sort of stamp that really makes it on top, that whenever you see that stamp, you know that there's a sort of digital notary
Maybe a
behind
proof
it.
of reserve kind of a thing.
Well, it could be that. For real estate, it could be, you know, in real estate, I believe, I don't want to go too long on this, but I believe the future of RWA comes with dividends. I think that's something that's, people disagree with this, but I think that there's going to be dividend that if I own a real estate NFT, for example, I'll get the profits every month. I need a sort of digital notary to read these reports that he's already filing and enter them into the DApp, into the smart contract. So for that, there's going to need to be a sort of new infra kind of piece of the puzzle that's going to come out. I think it's going to be a sort of stamp that people are going to recognize, and that's going to solve what you're talking about when it comes to that security aspect.
Yeah, you mentioned about like proof reserve. We saw a lot of centralized exchanges are doing that to prove like real ledger, we have the liquidities. Also for RWA projects, we saw them have attestations, like what kind of RWA tokens that we're holding with our custodians. This is like put in like a safety, extra safety layer for our end users, right? So then they know, okay, my assets are actually putting somewhere very safe places. So make sure I can get the yields and get the principals.
Yeah, I guess I can give you a real world example of how retail feels about it. Recently, there was one of the other TCG trading platforms, I won't name them, that had in their terms and conditions that, hey, I played this gotcha game, I've won this real asset. They show you the picture of the exact one it is. It's a $14,000 limited edition, first edition Pokemon card. And in the fine print it says, we will try to acquire this for you. And someone who won one of these cards realized it was actually listed on a completely separate site, up for sale for auction. Wasn't an instant buy, so you have to like actually get a hold of the person who has it listed. So they didn't even have this item in custody, and they may not actually be able to get it. And the reaction from users was, I don't think I have any trust in this system. I don't want to use this anymore. There's other competitors out there. Why is this the system I would opt into? So I think people are already trying to find unique ways to skirt having these assets in custody, and in general, users are sniffing it out pretty quick and saying this is not something I want to participate in. And I think that's how it should be. I mean, we've seen, you know, what happens when people say they've got the funds and they don't, right?
So with this we come to the end of the discussion. I mean, it was an interesting thing we started off with. Is there a clear divide between the institution side of the investment as far as the regulations are concerned, the anonymity is concerned, and the retail investors in the Web3 ecosystem, the Gen Z, the millennials, the new ecosystem? But you know, at the helm of affairs, we all would say that real world asset tokenization is the next big thing, because in the times to come, this is going to bridge the gap between the real world asset, the traditional investors and the modern investors, we can say. And that is going to be the talk of the time, at least for some time, for I must say for at least 2 or 3 years. We're going to be talking about real world asset as the next big thing. Then it might subside down, some new concept might come in. But this is all what the community wants, what the institution wants, and this is definitely the safest bridge between the traditional financial ecosystem, fractionalization of the larger assets, and of course the modern tokenization concepts. So with this all, we come to the end of this panel. Thank you so much, Marco, Mikey, Jeff, and Papi, for being interesting participants. Thank you so much. Bye-bye.
Thank you.
Thank you.
You want a photo?